Hi, everybody. My name is Bill Exeter. I'm the Chief Executive Officer for Exeter 1031 Exchange Services and Exeter Trust Company. Thank you so much for joining me today for the next episode in the Unraveling the Mystery series. Our goal is to provide quality education for investors and their advisors so that you can make better informed investment decisions. We named our series Unraveling the Mystery because we get lots of people who call us and say things like, I've talked to three or four companies, I've got three or four different answers. I'm really confused as to what qualifies, what really matters, what I need to do to be in compliance, etc. And so our goal is to unravel those mysteries, really point out what does matter, why there's confusion out there. A lot of the confusion is because there's lots of opinions out there. So that's our goal, is to unravel all of that mystery. As you know, we're in a very difficult and very challenging real estate market today, especially with all of the fairly quickly rise in interest rates. So we're getting a lot of calls about using a seller carryback note and a 1031 exchange transaction together in the exact same sale. And so today's episode is unraveling the mystery of 1031 exchanges and 1031 exchange transactions. So again, my name is Bill Exeter. I'm the CEO. That's my QR code. If you want to scan that, you get my contact information, plus the brochures and marketing and sales and educational information, etc. So with that, let's dive right into it. First, let's talk about the company for those of you who have not worked with us before. So Exeter 1031 Exchange Services is a qualified intermediary or an accommodator. We administer all types of 1031 exchanges. We cover all 50 states. That includes the forward 1031 exchange, where you sell first and then buy second or reinvest second. It includes the reverse 1031 exchange, where you buy first and then you sell second. It includes improvement 1031 exchanges, also referred to as build to suit or construction 1031 exchanges. We also handle zero equity. If you're selling something, it's dropped in value, you have no equity, it's still possible to do a 1031 exchange. We can talk more if that ever really impacts you. And then we're one of the few qualified intermediaries that actually handles or administers foreign property 1031 exchange transactions, where you're selling foreign rental property and reinvesting in other foreign rental property. We also serve as the exchange accommodation title holder. That's where we hold legal title to property when it's part of a reverse 1031 exchange or an improvement 1031 exchange transaction. Excuse me. Exeter 1031 Exchange Services is actually one of the few qualified intermediaries that has any type of regulatory or government oversight. Our industry has no capability to be regulated. There's no licensing ability. There's no regulatory body. And we wanted to be regulated. So we proactively chose to go down that path. We spent a couple of years of going through the review and approval process to get our own trust company charter. And I'll explain more about that in just a minute. Exeter 1031 has been doing this now for 19 years. We're coming up on our 20th year. Actually, the holding company is now in its 20th anniversary, 20th year of administering tax deferred exchanges and providing other tax deferred services. Personally, I've done over 125,000 1031 exchanges in my career. I'm now at the 40-year mark, which probably explains why I've got some hair loss. So having said that, we're very consultative, very advisory compared to a lot of exchange companies. We'll try to help you and your advisors work through the complicated issues, etc. And then I mentioned regulation. So we, again, chose to go down that path, and the result was Exeter Trust Company. So Exeter Trust Company is now licensed, regulated, and audited by the Wyoming Division of Banking. Again, that makes our operation one of the few qualified intermediaries that has any kind of regulatory oversight. That means we have all the typical fidelity bond, errors and omissions insurance. Because we're a financial institution, we also have the financial institution blanket bond coverage. It also gave us the ability to roll out other products that can help our investors. So we do self-directed IRAs or 401ks, where the investor wants to use the retirement account to invest in non-traditional investments or alternative assets, things like real estate, deeds of trust, mortgages, tax lien certificates, etc. We also do title holding trusts or land trusts where investors want to negotiate, acquire, and hold real estate in a confidential and private manner by keeping their name out of the public record. We handle specialty holding escrows. So if there's maybe a cash holdback or document holdback requirement after a real estate transaction, and if the escrow and the title company is not permitted to do that because of their regulatory issues, we can take a look at that with our trust powers. So that's kind of a quick overview of who we are. Let's dive right into our topic today. So again, like I said, we're operating in very difficult, very challenging times today. The real estate market has got all sorts of things being thrown at it. We are in a rapidly rising interest rate environment. We have a potential economic downturn around the corner. Some say it's not going to happen. Some say it's going to be a soft landing. Some say it'll be a hard landing. So we don't know exactly what's going to happen there. When all of that happens, lenders tend to tighten up their underwriting guidelines, so it's difficult to get a loan. So borrowers have a challenging time there. And there's all sorts of other distressed issues out in the real estate market today. Having said that, then you've got buyers who either qualify initially, and then as they get into the transaction, all of a sudden don't qualify, or they just don't qualify to begin with. So they actually can't close on the purchase of your real estate transaction. So what do we do with that kind of a scenario? And that's one of the scenarios where seller financing might be a way to get the deal done. Seller financing is often referred to as seller carryback notes or seller carryback financing or seller financing. And throughout the program, I'm just going to use the abbreviation SCBN, so you know that means seller carryback notes. Seller carryback notes could be in a number of different formats. Typically, it's going to be in a promissory note secured by a deed of trust or a promissory note secured by a mortgage. In some states, they're really big on land contracts or contract for deeds, which is very similar. So it could be in any of those formats where you're helping the buyer finance the purchase of your property. It can be a great tool. It's a highly effective tool for a number of scenarios. So certainly when you're dealing with a difficult real estate market and you're trying to help the buyer qualify to purchase your real estate, it can be a very good tool to help the buyer get in there and get it done. It could be a very valuable strategy for income tax planning, estate planning, and things like that. In some cases, folks say, look, I want to sell, I want to get out of real estate, and I do not want to reinvest in real estate. But I also don't want to get hit with a lot of income tax bills. So one way to do that is to sell the property under an installment sale or a seller carryback note, and that defers the gain over a period of time, generally over the term of the note. And there's pros and cons with that. It could also be a great way to structure reverse 1031 exchanges. With a reverse 1031 exchange, you're purchasing your new replacement property first, and then you're selling your existing property. The challenge is you haven't sold your relinquished property yet, so your equity is trapped. With this, you can go out and look, spend all the time you want to look for replacement property. When you find it, if the seller's willing to do seller carryback financing, that makes it a lot easier to buy the property, much less cash down, structuring that as part of a reverse 1031 exchange, because sellers almost always are willing to do that. And then you have the 180-day window to sell your current property. So highly effective tool with very difficult situations, but it's a creative tool and it helps solve a lot of the different problems. The challenge is, and in my mind, the problem is, the widespread belief is that 1031 exchanges and seller carryback notes or seller financing cannot be done together. And that is not true. They can absolutely be done together. It is done all the time. A seller financing is very, very beneficial, very positive for the buyer. The buyer doesn't really have anything to lose. Buyer's like, hey, help me out. I will borrow money from you, and great, that's terrific. So it's very favorable to the buyer, but it puts all the risk and all the challenges on the seller's shoulder, because the seller is going to sell the property, not get all the cash proceeds from the buyer, and that creates some challenges, especially when there's a 1031 exchange involved in the same transaction. So you're going to hear me say this a number of times tonight. That is always, always, always have your tax advisor, and I would even throw in your legal advisor, to sit down, review the terms of the note, going through the negotiation and make sure you're making the right decision for you. There's a lot of nuances here. You can get caught up in an accidental tax problem if you're not careful. So always make sure that your tax advisor is involved there. So first of all, why do so many people say you can't do it, and why is there so many challenges around the seller carryback note with a 1031 exchange in the same transaction? Well, as you know, when you're doing a 1031 exchange transaction, you're selling relinquished property. When that closes, it generates net proceeds. Now, most people associate net proceeds with cash or equity. You sell, you pay off your loan, you pay your closing costs, you end up with your net equity, your cash. But when you're doing a sale transaction and you're including a seller carryback note, now the net proceeds is more than just cash. So the entire net proceeds has to be reinvested in replacement property, just like a regular 1031 exchange. And that entire net proceed amount includes not only the cash, but also the net proceeds that are your seller carryback note. So you've got two components, cash and the seller financing. And that seller financing or the seller carryback note has to be used somehow toward the purchase of replacement property. That's where it gets confusing. So some people either don't know you can do that or don't know how to do that, or they may know that it can be done, but it's just complicated and they just don't want to get involved with it, etc. So the end of the story here is it can be done. It does get complicated, and it does put all the complications on the seller. So in a lot of cases, I would say as a seller, try really hard to negotiate the transaction without a seller carryback note. But in markets like today, sometimes you have to use a seller carryback note just to get the deal done. So I'm going to go through the options of how you can include the seller carryback note and a 1031 exchange in the same transaction. And really, you've got 5 options. So what are those options? And that's what we're going to talk about today. Before we get into the options, you have to make a decision. Do you want to include the seller carryback note inside of the 1031 exchange, or do you want to exclude the note so that it's outside the 1031 exchange? If you include the note, so it's inside the 1031 exchange, it would be tax deferred, assuming everything works out okay. If you exclude the note so that it's outside the 1031 exchange, it's a taxable event. So the seller carryback note would be taxable as an installment note. We'll get into more details on that later. Now, depending on which way you go, the seller carryback note will be drafted differently if you exclude it versus if you include it. That's important because when you're working with your closing agents, they need to know what you're going to do. They typically are going to draft the promissory note, and then if it's a deed of trust or mortgage or what have you, in your name as the seller. If you're going to include this inside the 1031 exchange, that is not the way they are going to be drafted. We'll talk more about that. So they need to know what you're doing, if you're going to include it or exclude it, so they know how to draft that particular note. So let's first off focus on including the seller carryback note. Most sellers, like all of us, we don't want to pay tax if we don't have to. And most of them want to defer the taxable gain, even when there's a seller carryback note. So they're naturally going to want to include the seller carryback note inside of the 1031 exchange transaction. And again, as I've said, it can be done, but it does get complicated and it is not easy to do that. It's very important, here I go again, but it's very important you talk to your tax advisors, talk to your qualified intermediary, and make sure you know exactly how this is going to work beforehand so that you don't get surprised at the last minute. But there's really 5 options that we're going to talk about tonight that cover what you can do, what the various options are you have or choices you have to make this all work. So I'm going to quickly summarize them here, and then we'll go into a little more detail. So option number 1 is to include the note, but you actually act as the lender. The seller is loaning the funds to the borrower, the buyer, and the funds are put into the closing, and that way the 1031 exchange has all cash at closing. That is probably the best choice if you can pull it off. It's the most efficient choice, but that's a lot of cash to come up with. Number two, maybe you can't come up with the cash up front, so the seller says, I need time. So the seller carryback note is drafted in the qualified intermediary's name. And then after closing, you come up with the cash and you deposit that into the 1031 exchange. We'll get into more detail again. Or three, one and two require you to come up with cash. And a lot of sellers cannot come up with that kind of cash. It's a lot of money. So the option number three is where the note would be drafted in the qualified intermediary's name. That way the 1031 exchange has cash in the note. And then you arrange to sell the note to an investor or a buyer of some type or a family member, what have you. And that way the 1031 exchange now has all cash and someone has bought the note out of the exchange. The fourth option is to put the note in the exchange. Again, the note will be drafted in the qualified intermediary's name, and you use it toward the payment or consideration paid for the new replacement property. And so that's another option as well. Again, we'll get into more detail. The fifth option is kind of like, well, the first four are not going to work. I give up. So I'm going to exclude the note from the 1031 exchange. Now, some people will exclude the note on purpose. There's tax reasons why you might do that. Other people may say, I'm going to try options 1 through 4. I'm going to put the note, the promissory note, in the qualified intermediary's name. And then if they can't find a way to deal with that, then that's okay. No harm, no foul. The promissory note is endorsed back to them after the 1031 exchange has completed. And again, it's going to be taxable as an installment note. So there's no penalty for trying to do it that way. And others are just going to say, I can't do number 1 through 4. They're just not going to work out for me. So they'll exclude the note. And in that case, the note is going to be drafted in the seller's name as the lender, if you will. And it's excluded from the 1031 exchange completely altogether. That's going to be taxable as an installment note under Section 453 of the Internal Revenue Code. So let's get into more detail on all of these options. So option number 1, this again, like I said, is probably the cleanest and the most effective strategy for dealing with a seller carryback note. If you're in a position where you can do this, this is the way to go. It's just cleaner, it's more efficient, there's less moving parts, etc. So in this case, you say, yep, I'm willing to do a seller carryback note. I'm going to fund it. So the seller comes out of pocket with new cash equal to the seller carryback note amount. You actually put money out of your pocket into the closing, just like a lender would. You fund the note. And that way, when the closing occurs, the 1031 exchange has all cash. You can easily complete the 1031 exchange. So literally, you as the seller are acting as the lender. You're putting cash into closing. The promissory note and the deed of trust or mortgage will be drafted in your name because you lent the money. And it's really an all-cash closing at that point in time. So again, that's the most efficient, the cleanest, best way to approach it if you can come up with that kind of cash. The second option is the seller says, I can come up with the cash. I just need some time. I can't come up with it before closing. So at closing, I'm going to be short. So in that case, the promissory note and the deed of trust or the mortgage, they're going to be drafted in the qualified intermediary's name. Now, in our case, because we have a trust company and all the funds are held by the regulated entity, Exeter Trust Company, the promissory note and deed of trust or mortgage will be actually drafted in Exeter Trust Company as trustee of the qualified trust account for your 1031 exchange. So it depends on how the qualified intermediary operates. But in our case, we have that regulated entity. What that does is now the closing has occurred and the 1031 exchange account now is holding cash, but it's also holding the seller carryback note. Both of them are inside the 1031 exchange. Now, at that point, you're going to arrange to come up with the cash. Somehow the seller raises the cash, and then you put the cash into the 1031 exchange account. It's called boot paid in. And now the 1031 exchange account has all cash, and they can proceed with closing on the replacement properties and finish with the 1031 exchange. And then after the entire 1031 exchange is completed, then the seller carryback note is going to be endorsed and transferred over to you as the seller. So in both cases, option 1 and option 2, the only thing that will be taxable is the interest income paid on that seller carryback note. The taxable gain, and in most cases, the depreciation recapture will be deferred because you did it through a 1031 exchange transaction. This is This is often kind of referred to as buying your note out of your own 1031 exchange. That's not the correct explanation, but that's an easy way to explain it. You're putting money into the exchange, and then after the exchange is over, you get the note back. But it is an effective way of getting this done. Not quite as clean as option number one, because originally the note's going to be in our name, and then later we have to endorse it to you, and then we have to assign the deed of trust or the mortgage to you. But it works and it is effective. When you're doing this and you're effectively borrowing money from someplace and then putting the money into the 1031 exchange, it's better, although in most cases it's just not an option, but it's better if you have an affiliate. So it may be a related entity, a family member, whoever that actually does that, loaning the money into the 1031 exchange and what have you. But again, after that's all done, you have paid boot in, you have received boot through the endorsement of the note back to you. That's boot paid and boot received, and it nets to zero, and there's no tax consequence for that. Having said that, cash is king. So it's easy to say option one and option two are the best way to go, but that requires a lot of cash to be raised somehow. And most investors or sellers are not in a position to raise that kind of cash, so it's not necessarily going to be an option for most investors. So what do we do with that? Well, if you can't raise the cash, then the first and second options are kind of out of the picture, but there are 3 additional options that might work for you. So option number 3 is the same kind of structure as 2, in that the promissory note is drafted in our name as the qualified intermediary. So the 1031 exchange has both the cash and the note inside the 1031 exchange transaction. And then the seller arranges to sell that seller note, the seller carryback note, to another party. It could be a related party, it could be a non-related party. There's a lot of note brokers and note investors out there who will certainly take a look at that, and they love to buy those type of things all day long. Once you sell the note, then of course the qualified intermediary has sold the note. They've endorsed the note to whoever the buyer was, and in return they're getting cash proceeds. So now the 1031 exchange has all cash and can proceed to purchase the replacement property and finish or wrap up the 1031 exchange. This strategy can definitely work, but it's an expensive option typically, because most note investors who want to buy the note, they're expecting a 15 or maybe a 20% return on their money. A lot of the notes today are, say, between 5 and 8 or 9%, maybe 10%. And that's not good enough for them to buy the note. So they're going to discount what they pay you on the note. So if you've got a $100,000 face note, you're not going to get $100,000. They're going to discount that to get the yield that they want on their investment return. So it's important to note this works, but it can be expensive. If you've got a very large taxable gain, and this is the only way you can do this, option 3 is the only thing you can do to get this done, it still might make sense, even though it's an expensive discount, because you may have a large taxable gain. If you have a small taxable gain, it might make more sense just to pay the tax and not sell the note at a discount. So again, that's where you and your tax advisor can sit down and kind of crunch the numbers and figure out what is best for you. Option number 4, this gets tricky, requires some creativity, but it can be done. We do it off and on throughout the years. Option number 4 is where the seller carryback note, or the promissory note, and the deed of trust or mortgage is drafted in our name as qualified intermediary. So again, the sale closes. We are now holding not only the cash, but we're also holding the seller carryback note. So we have both. Everything is included inside of the 1031 exchange transaction. Then the seller locates the replacement property they want to acquire, and they approach the seller and say, look, I would like to buy your property. I've got this much in cash, but I'd like you to take this promissory note, this seller carryback note. I will endorse it to you as part of the payment or part of the consideration for buying your replacement property. And that could certainly work if the seller is willing to do that. And if they agree to it at the closing, we're going to wire the cash to the closing, and we're going to endorse the note and assign the deed of trust or mortgage to the seller of your replacement property. The challenge is most sellers aren't willing to take a third-party note. They don't know who the note is, they don't know the other party, they don't know the property where it came from, and so it just scares them. So it's difficult to do that, but it can be done, and there are very creative real estate brokers out there, or exchange consultants or counselors who can help you with that. There's organizations where the brokers specialize in those type of transactions. So there's a lot of ways to get that done if you need to get it done. The fifth option is where you just say, you know what, none of these options are going to work for me, so I'm going to exclude the note from the 1031 exchange transaction. And that way it becomes taxable. So the last option is I'm going to exclude it. As I said before, it might be that you decide I'm going to try it. I'm going to try option 1 through 4. I'm going to include the note. And then if I can't figure out how to get option 1 through 4 to work, then we endorse the note to you and it falls into option 5. It might be that you've decided, I'm just not going to try these. And some people do option number 5 on purpose. For tax planning purposes, they may want the seller carryback note outside of the 1031 exchange. So again, you need to meet with your tax advisor to figure out what is right for you, what works best for you. But this last option essentially means the promissory note and the deed of trust or mortgage are going to be drafted in the seller's name. That excludes it from the 1031 exchange transaction, and it becomes taxable under Section 453 of the Internal Revenue Code. What it boils down to is now you have a 1031 exchange that is funded with the cash or the equity portion, and the seller carryback portion represents net proceeds that are not being reinvested in the 1031 or through the 1031 exchange and replacement property. So that triggers the taxable event for the seller carryback note. The cash can still be used toward the purchase of replacement property. Now, it depends on how much cash, it depends on your current adjusted cost basis in the property you're selling as to whether the cash is still going to provide enough or any tax deferred benefit through the 1031 exchange. So again, if you're going to exclude the note, you need to sit down with your tax advisor and say, okay, does a 1031 exchange still make sense for me? Can I still defer some tax? And number 2, how much tax am I going to pay this year and over the subsequent years under the installment note? And make sure you know exactly what's going to happen there, because surprise is going to happen. The biggest surprise there, well, first of all, so the seller carryback note, of course, is going to become your taxable gain. That's realized because you did not reinvest it through the 1031 exchange transaction. Typically, that means your taxable gain is deferred over the term of the note. And the way it typically works, this is a little oversimplified, but effectively the percentage of principal that is paid every year on the note, so the amount of principal that the borrower pays you every year, you calculate what percentage that is of the total principal. So what percentage of the principal is paid down every year, and that percentage of the taxable gain will be recognized or taxable that year. So really the tax consequence is deferred over the term of the note. And then once each year arrives, you calculate how much is taxable, and that's an effective way of reducing the tax, your adjusted gross income, and hopefully your tax rate or your tax bracket, etc. Keep in mind, if the borrower / buyer decides to pay off that note, and it happens all the time, they decide to refinance, they go to a bank, they refinance, all of a sudden you get the phone call or the fax or the email that says, hey, we need a payoff statement here, what do we owe you? It's going to trigger the rest of your deferred gain in that year when the note is paid off. So that's one of the negatives you got to watch out for. With option number 5, there's all sorts of exceptions. There's all sorts of special considerations that you have to keep your eyes open for. So again, that's why I always suggest over and over and over, make sure you talk to your tax advisor. Depreciation can be tricky. Depreciation recapture. In most cases, if you're including it with the 1031 exchange, it'll be tax deferred. If you're excluding it from the 1031 exchange, depreciation recapture may be taxable the year of sale, or it may be deferred over the term of the note. So be careful. Have your tax advisor work with you on that. Seller carryback notes that are in excess of $5 million have special consideration. So you have to be very careful with those type of things. And again, there's other nuances that we haven't had time to discuss today. So you always want to sit down with your tax advisor before you sign any contract of sale so that you can make sure you're making the best informed investment decision possible. And with that, we hope we have unraveled the mystery for seller carryback notes with 1031 exchanges today. If you have any follow-up questions, please reach out to us. We're always available to chat and discuss. We're always kind of consultative and advisory in nature. We're happy to jump on a conference call with that. Or you can shoot us an email too. The email is ask@exeterco.com. And again, thank you for joining us today for the next episode of our Unraveling the Mystery series, and hope to see you next time.